Question 1. Which of the following types of life insurance policies is most suitable for a person seeking permanent coverage with the flexibility to adjust premiums and death benefits over time? A. Term life insurance. B. Whole life insurance. C. Universal life insurance. D. Variable life insurance. Answer C. Universal life insurance. Explanation. Universal life insurance provides flexibility in both premiums and death benefits. This type of policy allows the policyholder to adjust their premium payments and a death benefit, making it ideal for individuals who require flexibility throughout their lifetime. The policyholder can also accumulate cash value that grows based on the performance of the insurer's investments. Term life insurance A only provides coverage for a specific term and does not build cash value or offer premium flexibility. Whole life insurance B provides permanent coverage with fixed premiums and a guaranteed death benefit, but does not offer as much flexibility as universal life. Variable life insurance D allows for investment options within the policy but doesn't provide the same level of flexibility in premiums and death benefits as universal life. Question 2. Mr. Williams has been advised by his insurance agent that his homeowner's policy includes coverage for both named perils and all-risk coverage. Which of the following best describes this situation? A. The policy only covers risks specifically listed in the policy document. B. The policy covers all types of risks unless specifically excluded. C. The policy provides coverage only for damages to personal property. D. The policy includes both named peril and broad coverage options. Answer B. The policy covers all types of risks unless specifically excluded. Explanation. An all-risk or open peril policy provides coverage for all risks unless specifically excluded by the policy terms. This is different from a named peril policy, which only covers the risks explicitly listed in the policy. The combination of both types of coverage in the same policy indicates broad protection with exceptions stated in the exclusions. Named peril A only covers those perils listed, so if the peril is not specifically named, it is not covered. Personal property coverage C is a component of homeowners insurance but does not directly address the policy's coverage of all risks. Named peril and broad coverage D is an incorrect response, as the combination of named peril with all risk coverage in a single policy doesn't mean both types are equally available. Question 3. Scenario. Sarah, a newly licensed insurance producer in New Hampshire, is working with a client who is interested in purchasing life insurance. The client is asking for details about the policy options available. Sarah explains the pros and cons of term life, whole life, and universal life policies, but does not provide any written documentation of these options. The client decides to purchase a universal life policy. Which of the following is the most appropriate course of action for Sarah after the sale date? Sarah should submit the policy to the client and wait for them to review it on their own. B. Sarah should ensure the policy is delivered with clear written documentation of the coverage and any changes from the options explained. C. Sarah should only provide the client with the policy if they request it in writing. D. Sarah should contact the insurance company to confirm the client's coverage, as she is not responsible for client communication. Answer B. Sarah should ensure the policy is delivered with clear written documentation of the coverage and any changes from the options explained. Explanation. Under New Hampshire regulations, insurance producers must ensure that clients receive written documentation of the policy terms, conditions, and any variations from the options explained during the sales process. This is to ensure transparency and to confirm that the client understands the policy they have purchased. Documentation serves as protection for both the client and the insurance producer. Additionally, it fulfills the duty to disclose all material facts, which is part of the producer's fiduciary responsibility. Option A does not fulfill the obligation to provide written documentation and explain changes in the coverage. Option C is insufficient, as it doesn't align with the responsibility to proactively provide written details about policy options and decisions. Option D is incorrect, as it shifts responsibility away from the producer to the insurer, which is not in line with the producer's obligations. Question 4. Which of the following statements about underwriting in life insurance is correct? A. Underwriting primarily focuses on determining the amount of coverage a person is eligible for. B. Underwriting decisions are based solely on the applicant's health history and current medical conditions. C. Underwriting takes into account an applicant's age, health, occupation, and lifestyle to assess risk. D. Underwriting eliminates all risks associated with applicants, ensuring that all applicants are insurable. Answer. C. Underwriting takes into account an applicant's age, health, occupation, and lifestyle to assess risk. Explanation: life insurance underwriting is the process through which the insurer evaluates an applicant's risk level to determine eligibility for coverage and appropriate premium rates. This process considers a variety of factors such as age, health, occupation, and lifestyle, all of which affect the applicant's overall risk. The insurer uses these factors to assess whether the applicant presents higher risk and whether they should be accepted for coverage. Option A is incorrect because underwriting involves more than just determining coverage amount. It assesses risk to determine pricing and insurability. Option B is only partially correct as health history is important, but other factors like occupation and lifestyle are also considered. Option D is incorrect because underwriting does not eliminate all risks. Some applicants may be denied coverage based on their risk profile. Question 5. Which of the following is not a characteristic of a valid insurance contract? A. Offer and acceptance. B. Legal purpose. C. Exchange of tangible property. D. Competent parties. Answer C. Exchange of tangible property. Explanation: for an insurance contract to be valid, it must meet several essential elements. Offer and acceptance are necessary for both parties to agree on the terms. Legal purpose ensures that the contract is for lawful activities such as insuring against risk. Competent parties means that both parties must have the legal capacity to enter the contract. However, the exchange of tangible property is not a requirement for a valid insurance contract. Instead, insurance contracts are based on the exchange of promises, where one party promises to indemnify the other in exchange for premium payments. Option A is incorrect because it is a necessary characteristic of a valid contract. Option B is incorrect because it is a required element of an insurance contract. Option D is incorrect because competent parties are essential for the contract's validity. Question 6. Mr. Baker, a client, has purchased a home insurance policy that covers damages caused by fire, lightning, and theft. However, the policy specifically excludes coverage for flooding. After a heavy rainstorm, Mr. Baker's basement is flooded. Which of the following would be true? A. Mr. Baker's policy will cover the flooding under the theft coverage clause. B. The policy will not cover flooding as it is explicitly excluded under the policy's terms. C. The policy will automatically cover flooding due to the recent storm. D. Mr. Baker will need to purchase additional coverage for the flood damage from his agent. Answer B. The policy will not cover flooding as it is explicitly excluded under the policy's terms. Explanation: insurance policies are legally binding contracts and they provide coverage only for risks specifically included and not excluded. In this case, the policy excludes coverage for flooding. Even if the flooding is caused by a storm, if the risk is excluded, the insurer will not provide coverage for it. Option A is incorrect because theft coverage does not extend to flood damage. Option C is incorrect because exclusions override any potential automatic coverage. Option D is correct in that Mr. Baker could purchase additional coverage, such as flood insurance, to protect against this type of risk. Question 7. Which of the following is true about the taxation of life insurance policies in New Hampshire? A. Life insurance premiums are fully deductible from the policyholder's federal taxable income. B. Death benefits from life insurance policies are generally not subject to federal income tax. C. The cash value of life insurance policy is taxed as ordinary income when withdrawn. D. Life insurance policies issued in New Hampshire are exempt from all state taxes. Answer B. Death benefits from life insurance policies are generally not subject to federal income tax. Explanation: in the U.S., life insurance death benefits are generally not subject to federal income tax if the proceeds are paid to beneficiaries in a lump sum. However, this rule may vary if the death benefit is paid out as part of an annuity or if the policyholder has taken out loans against the cash value. Option A is incorrect because life insurance premiums are typically not deductible on federal taxes except in certain circumstances such as for business-related policies. Option C is partially correct in that the cash value of a life insurance policy may be taxed, but only if it is withdrawn and exceeds the premiums paid, i.e., gains are taxable. Option D is incorrect because life insurance policies in New Hampshire may still be subject to certain state taxes, such as premium taxes. Question 8. Which of the following best defines insurable interest in relation to life insurance? A. It is the amount of premium a policyholder is willing to pay to maintain a life insurance policy. B. It is the financial interest a person has in the continued life or health of the insured person. C. It is the amount of death benefit a beneficiary will receive under a policy. D. It is the period of time during which a life insurance policy is in force. Answer: B. It is the financial interest a person has in the continued life or health of the insured person. Explanation: insurable interest is a fundamental concept in insurance, especially life insurance, and is required for a policy to be legally valid. A person has insurable interest if they would suffer a financial loss or hardship upon the death or incapacity of the insured individual. This ensures that life insurance contracts are not used for speculative or gambling purposes. Option A is incorrect because insurable interest relates to the financial stake in the insured's life, not the premium amount. Option C is incorrect because insurable interest is about the relationship between the policyholder and the insured, not the death benefit amount. Option D is incorrect as insurable interest is unrelated to the period of time the policy is in effect. Question 9. Which of the following is a key responsibility of an insurance producer when dealing with client funds? A. The producer is required to co-sign all client checks before the insurance company can process them. B. The producer must deposit client premiums into a trust or escrow account and not use them for personal purposes. C. The producer must immediately transfer any client funds to the insurance company as soon as they are received. D. The producer may invest client premiums in their personal business accounts to ensure high returns. Answer: B. The producer must deposit client premiums into a trust or escrow account and not use them for personal purposes. Explanation: insurance producers are fiduciaries, meaning they must act in the best interests of their clients, including safeguarding client funds. Premium payments must be kept in a separate trust or escrow account to ensure they are not commingled with personal funds. This helps maintain the integrity of the transaction and ensures the insurance company receives the funds promptly. Option A is incorrect because co-signing checks is not a required procedure for insurance producers. Option C is partially correct but incomplete as it does not address the necessary requirement to hold funds in a trust account before transferring them. Option D is illegal and unethical as it violates the duty to protect client funds. Question 10. Which of the following is a primary function of an insurance producer's continuing education requirements in New Hampshire? A. To allow producers to increase their commission rates. B. To ensure that producers remain aware of new laws, regulations, and industry trends. C. To grant producers exclusive rights to sell certain types of insurance policies. D. To allow producers to conduct claims investigations on behalf of clients. Answer: B. To ensure that producers remain aware of new laws, regulations, and industry trends. Explanation: continuing education. C. Requirements for insurance producers are designed to keep them informed about changes in laws, regulations, and industry practices. This helps ensure that producers provide accurate and up-to-date information to clients, maintain ethical standards, and stay compliant with state requirements. Option A is incorrect because continuing education does not affect commission rates. Option C is incorrect as continuing education does not grant exclusive rights to sell certain types of insurance. Option D is incorrect as insurance producers are not authorized to conduct claims investigations unless they are involved in the claims process directly. Question 11. What is the primary purpose of a waiver of premium rider in a life insurance policy? A. To reduce the death benefit in case of a policyholder's disability. B. To allow the policyholder to skip premium payments if they become disabled. C. To increase the death benefit after the policyholder reaches a certain age. D. To convert a term policy into a permanent policy without additional underwriting. Answer: B. To allow the policyholder to skip premium payments if they become disabled. Explanation: a waiver of premium rider is an additional benefit that can be added to a life insurance policy which allows the policyholder to skip premium payments in the event of a disability. If the policyholder becomes disabled and is unable to work, the insurance company will waive the premium payments while the policy remains in force. Option A is incorrect because the waiver of premium rider does not affect the death benefit in the case of a disability. Option C is incorrect as the rider does not affect the death benefit after a certain age. Option D is unrelated to the purpose of the waiver of premium rider, which is not for converting policies. Question 12. Which of the following is an example of a hazard in insurance terms? Say, a hurricane that causes widespread damage. B. A faulty electrical system that increases the risk of a fire. C. A person's previous history of heart disease. D. Fire that results in property loss. Answer: B. A faulty electrical system that increases the risk of a fire. Explanation: in insurance, a hazard refers to a condition or situation that increases the likelihood of a loss occurring. A faulty electrical system is a hazard because it increases the risk of a fire happening, but it is not a direct loss itself. That would be the peril, such as a fire. Option A is a peril, not a hazard. A peril is the event that causes the loss, such as the hurricane. Option C refers to a moral hazard, which is a factor that indicates a person's tendency to engage in risky behavior due to the perceived safety net provided by insurance. Option D is loss that happens as a result of hazard, but it is not considered hazard itself. Question 13. Which of the following is a primary responsibility of an insurance agent when presenting an insurance policy to a client? A. To guarantee that the client will receive a payout from the insurance company. B. To explain the terms, conditions, and exclusions of the policy in detail. C. To invest the client's premiums in a way that maximizes returns. D. To persuade the client to purchase the highest level of coverage available. Answer: B. To explain the terms, conditions, and exclusions of the policy in detail. Explanation: one of the primary responsibilities of an insurance agent is to ensure that the client fully understands the terms, conditions, and exclusions of the policy. The agent must provide clear and accurate information to help the client make an informed decision about purchasing insurance. Option A is incorrect because agents cannot guarantee payouts. This is dependent on the terms of the policy and the occurrence of the insured event. Option C is incorrect as agents are not responsible for investing premiums. They are primarily responsible for facilitating coverage. Option D is incorrect because the agent should not push the client to buy excessive coverage, but instead tailor the policy to the client's needs. Question 14. Which of the following actions is considered unethical for an insurance agent in New Hampshire? A. Offering a discount to clients for multiple policies with the same insurer. B. Accepting gifts from clients as long as they are not too valuable. C. Misrepresenting the terms of an insurance policy to a potential client. D. Explaining a policy's exclusions and limitations in a clear and understandable manner. Answer: C. Misrepresenting the terms of an insurance policy to a potential client. Explanation: insurance agents have a fiduciary duty to act in the best interests of their clients and must be truthful when describing policy terms. Misrepresenting policy details is considered unethical and can lead to disciplinary action from regulatory authorities. Option A is generally ethical if the discount is properly applied within the rules of the insurer. Option B is unethical depending on the value of the gift, as accepting gifts from clients could create conflicts of interest or perception issues. Option D is an ethical action and a required part of the agent's responsibilities. Question 15. Which of the following would be an example of an occurrence under commercial general liability CGL policy? A. A car accident that occurs while a delivery driver is driving to a client's location. B. Fire that damages the property of business owner. C. An employee is on the job injury while using piece of machinery. D. Customer slipping and falling in store due to wet floor. Correct answer: D. A customer slipping and falling in a store due to a wet floor. Explanation: in the context of a commercial general liability CGL policy, occurrence refers to an incident or event that leads to a liability loss. In this case, a customer slipping and falling due to a wet floor is a classic example of an occurrence that could lead to a DLA. Option A is a car accident and would typically fall under automobile insurance, not CGL. Option B refers to property damage, which might be covered under a property insurance policy. Option C refers to workers' compensation coverage, not CGL. Question 16. Which of the following is a key characteristic of a whole life insurance policy? A. It provides coverage only for a limited term after which the policy expires. B. It offers coverage as long as premiums are paid and it accumulates cash value over time. C. It is a high-risk investment option that can potentially provide high returns. D. It is typically used for short-term coverage and offers minimal premiums. Answer: B. It offers coverage as long as premiums are paid and it accumulates cash value over time. Explanation: whole life insurance provides coverage for the insured's entire life as long as premiums are paid. In addition to providing death benefit, it also accumulates cash value, which the policyholder can borrow against or withdraw depending on the terms of the policy. Option A is incorrect because whole life insurance provides lifelong coverage, unlike term insurance. Option C is incorrect because whole life insurance is not an investment designed for high returns, though it does accumulate cash value. Option D is incorrect because whole life insurance tends to have higher premiums due to its permanent coverage and cash value accumulation. Question 17. What does the term coinsurance refer to in a health insurance policy? A. The amount the insurance company pays before the policyholder's deductible is met. B. The portion of the claim that the policyholder must pay after the deductible is satisfied. C. The total annual amount policyholder must pay for healthcare services. D. The amount the insurance company charges for coverage under the policy. Answer B. The portion of the claim that the policyholder must pay after the deductible is satisfied. Explanation. Coinsurance refers to the percentage of the covered medical expenses that the policyholder must pay after the deductible has been met. For example, if a policy has a 20% coinsurance, the policyholder pays 20% of the covered costs and the insurer pays the remaining 80%. Option A refers to the deductible, not coinsurance. Option C refers to the out-of-pocket maximum, which is different from coinsurance. Option D is incorrect because it refers to premiums, not coinsurance. Question 18. Which of the following is an example of a moral hazard? A. A person intentionally setting a fire to collect insurance money. B. A policyholder installing a security system to reduce the risk of burglary. C. A business purchasing property insurance to protect against fire damage. D. A person living in a high-risk area for earthquakes purchasing earthquake coverage. Answer A. A person intentionally setting a fire to collect insurance money. Explanation. A moral hazard occurs when a person takes more risks because they know they are covered by insurance. In this case, intentionally setting a fire to collect insurance money is a moral hazard because the person is taking an action that increases the risk in order to benefit from the insurance payout. Option B is an example of a policyholder taking proactive steps to reduce risk, which is not a moral hazard. Option C is a standard insurance decision, not a moral hazard. Option D is an example of a policyholder purchasing coverage for a natural disaster, which does not involve intentionally increasing risk. Question 19. What is the primary purpose of a binding receipt in a life insurance application process? A. To guarantee that the applicant will receive a policy. B. To provide proof of payment to the insurer for the applicant. C. To allow immediate coverage to the applicant until the policy is issued. D. To waive the need for medical underwriting for the applicant. Answer C. To allow immediate coverage to the applicant until the policy is issued. Explanation. A binding receipt is a temporary agreement that provides immediate coverage to the applicant, usually until the insurance company has completed the underwriting process and officially issued the policy. If the applicant is found to be insurable, the coverage continues once the policy is issued. Option A is incorrect because a binding receipt does not guarantee policy issuance. It only provides temporary coverage. Option B is incorrect as the binding receipt is about temporary coverage, not payment proof. Option D is incorrect because a binding receipt does not waive underwriting. It provides temporary coverage until underwriting is complete. Question 20. Which of the following is typically excluded from a standard homeowner's insurance policy? A. Theft. B. Fire damage. C. Flood damage. D. Personal injury. Answer C. Flood damage. Explanation. Flood damage is typically excluded from standard homeowners insurance policies. Homeowners may need to purchase separate flood insurance to cover damages caused by flooding. Option A is incorrect because theft is usually covered under standard homeowners insurance. Option B is incorrect because fire damage is also typically covered. Option D is incorrect because personal injury is often covered by liability provisions in the policy. Question 21. Which of the following is an example of contributory negligence in a liability case? A. A person causing damage by intentionally breaking a rule. B. A person who is partially at fault for their own injury due to their own actions. C. A person injured by a hazardous condition they were unaware of. D. A person filing a claim for an injury that occurs at work. Answer B. A person who is partially at fault for their own injury due to their own actions. Explanation. Contributory negligence occurs when the injured party's own actions contribute to their injury in a legal context. If the injured person's negligence played a role in the incident, it may reduce or eliminate their ability to recover damages. Option A is an example of intentional wrongdoing, not negligence. Option C refers to an injury due to unknown hazards, which is not contributory negligence. Option D refers to workers' compensation, where negligence is not typically a factor. Question 22. Which of the following is the primary purpose of a coinsurance clause in a property insurance policy? A. To allow the insured to claim the full amount of the policy's limit. B. To encourage the insured to maintain a certain level of coverage. C. To prevent underinsurance by requiring the insured to insure their property for its full value. D. To reduce the premiums paid by the insured for coverage. Answer. B. To encourage the insured to maintain a certain level of coverage. Explanation. The coinsurance clause in a property insurance policy requires the policyholder to insure their property to a certain percentage of its value, usually 80%, 90%, or 100%, to avoid penalties in case of a claim. If the insured does not meet the required coverage level, they may not receive full compensation for losses. Option A is incorrect because the clause doesn't allow for claiming the full amount if the coverage is insufficient. Option C is partially correct in that the coinsurance clause helps prevent underinsurance, but it is designed to encourage adequate coverage, not necessarily full value. Option D is incorrect as coinsurance typically increases the insured's obligation rather than reducing premiums. Question 23. Which of the following is a potential disadvantage of a deductible in an insurance policy? A. The insurance premiums are higher. B. The insured must pay a portion of the claim before the insurer pays. C. The policyholder may be penalized for filing too many claims. D. The insurance company will deny claims more often. Answer. B. The insured must pay a portion of the claim before the insurer pays. Explanation. A deductible is the amount the insured must pay out of pocket before the insurance company will start paying for a claim. A higher deductible usually lowers premiums, but also means the policyholder must bear a larger portion of the financial burden in the event of a loss. Option A is incorrect because deductibles are typically associated with lower premiums, not higher. Option C refers to penalties for too many claims, which may apply in some cases, but is not a direct disadvantage of a deductible. Option D is not generally true, as the deductible doesn't affect the claim denial rate, but rather the claim payout. Question 24. In the context of life insurance, what does the term accidental death rider refer to? A. It increases the death benefit if the insured dies from a terminal illness. B. It provides a payout to the insured if they survive a critical illness. C. It increases the death benefit if the insured dies as a result of an accident. D. It covers medical expenses incurred due to an accident. Answer. C. It increases the death benefit if the insured dies as a result of an accident. Explanation. An accidental death rider is an additional provision added to a life insurance policy that pays an extra benefit if the insured's death is caused by an accident. This rider provides financial protection for the insured's beneficiaries in the event of an accidental death. Option A describes different rider for terminal illness. Option B refers to rider for critical illness, not accidental death. Option D is unrelated to the death benefit and typically pertains to health insurance. Question 25. Which of the following is a type of liability insurance? A. Health insurance. B. Homeowners insurance. C. Workers' compensation insurance. D. Auto insurance. Answer. D. Auto insurance. Explanation. Auto insurance is a type of liability insurance that covers the insured's legal responsibilities when they cause bodily injury or property damage to others in an accident. Liability coverage is a key component of most auto insurance policies. Option A is health insurance, which covers medical costs, not liability. Option B covers property and other risks associated with home ownership, but typically includes liability coverage as well. Option C is workers' compensation, which covers employee injuries, but is not specifically liability insurance. Question 26. What does the term underwriting refer to in insurance? A. The process of negotiating premiums between the insurer and the insured. B. The procedure of investigating and accepting or rejecting insurance applications. C. The legal action taken when an insurance policy is violated. D. The process of determining how much coverage a policyholder needs. Answer. B. The procedure of investigating and accepting or rejecting insurance applications. Explanation. Underwriting is the process used by insurance companies to assess the risk of insuring an applicant and to determine the terms and premiums of the policy. Underwriters evaluate factors such as health, lifestyle, and past claims history to decide whether to accept or reject an application. Option A is incorrect because underwriting is not about negotiating premiums. It is about evaluating risk. Option C refers to claims processes, not underwriting. Option D is incorrect because determining coverage needs is part of policy sales, not underwriting. Question 27. What is the difference between a term life insurance and whole life insurance? A. Term life insurance provides coverage for a limited time, while whole life insurance provides lifelong coverage and accumulates cash value. B. Term life insurance is more expensive than whole life insurance. C. Whole life insurance is only available to people under 30, while term life insurance is available to anyone. D. Term life insurance offers investment opportunities, while whole life insurance does not. Answer A. Term life insurance provides coverage for a limited time, while whole life insurance provides lifelong coverage and accumulates cash value. Explanation. Term life insurance provides coverage for a specified period, e.g., 10, 20, or 30 years, and has no cash value accumulation. Whole life insurance, on the other hand, offers permanent coverage and builds cash value over time. Option B is incorrect because term life insurance is usually cheaper than whole life insurance. Option C is incorrect. Whole life insurance is available to people of all ages, not just those under 30. Option D is incorrect because both types of life insurance have limited investment opportunities. However, whole life insurance allows for cash value accumulation. Question 20. Which of the following is a common exclusion under a standard homeowner's insurance policy? A. Theft of personal property. B. Damage caused by vandalism. C. Damage caused by an earthquake. D. Fire damage. Answer C. Damage caused by an earthquake. Explanation. Damage caused by earthquakes is typically excluded from a standard homeowner's insurance policy. Homeowners who live in earthquake-prone areas are often required to purchase additional earthquake coverage to protect against this type of risk. Option A is incorrect because theft is generally covered under homeowners insurance. Option B is incorrect as vandalism is typically covered by homeowners insurance. Option D is incorrect because fire damage is usually covered. Question 29. Which type of insurance policy is most appropriate for covering potential losses in case of a business interruption? A. Property insurance. B. Business interruption insurance. C. General liability insurance. D. Workers' compensation insurance. Answer B. Business interruption insurance. Explanation. Business interruption insurance helps businesses cover the financial losses that occur when normal operations are halted due to events like fire, storm damage, or other covered incidents. It compensates for lost income, rents, or operating expenses during the period of interruption. Option A covers property damage but not loss of income due to business interruption. Option C covers third-party liabilities, not business interruptions. Option D covers employee injuries, not business income. Question 30. What is the liability limit on an insurance policy? A. The maximum amount the policyholder can pay for premiums. B. The maximum amount the insurer will pay for covered losses under the policy. C. The minimum amount the policyholder must pay out of pocket before insurance coverage kicks in. D. The maximum number of claims the insured can file under the policy. Answer B. The maximum amount the insurer will pay for covered losses under the policy. Explanation. The liability limit is the maximum amount an insurer will pay for a claim or series of claims under an insurance policy. Once the limit is reached, the policyholder is responsible for any remaining costs. Option A is incorrect. The liability limit pertains to claims, not premiums. Option C refers to the deductible, not the liability limit. Option D is incorrect because liability limits relate to the monetary coverage provided, not the number of claims.